Welcome to Explain the Charts, your go-to source for in-depth market analysis. Today, September 14th, 2025, we're dissecting the Australian dollar against the US dollar, AUDUSD, by combining the latest news with detailed chart data. Recent headlines present a fascinating tug-of-war. Remember that period in late 2024 to early 2025, when the Aussie dollar seemed to be collapsing, hitting a 24-month low below 62.3 US cents? This downturn, which we can clearly see in this daily chart, was largely attributed to a surprise hawkish tone from the US Federal Reserve, signaling fewer rate cuts for 2025 than markets had anticipated, pushing the AUDUSD lower towards the 0.61 to 0.62 range. However, fast forward to today, and the narrative has shifted dramatically. Just 2 days ago, on Friday, September 12th, FX Street reported AUDUSD surging to a fresh 10-month high near 0.6670, exhibiting a clear bullish bias. This recent strength is underpinned by robust Australian economic data, diminishing prospects of further Reserve Bank of Australia rate cuts, and a cheerful market sentiment. While U.S. market sentiment improved due to rising expectations for 3 Federal Reserve rate cuts this year. This divergence in central bank outlooks, with the RBA potentially holding rates and the Fed easing, is a significant tailwind for the AUD. Let's zoom in on the daily chart, specifically from early August 2025 to now, to truly appreciate the recent bullish momentum. After trading sideways in the 0.64 to 0.65 range through much of August, we observed a decisive breakout. Notice the strong green candles appearing around late August and into September, indicating significant buying pressure. The price successfully pushed past previous resistance levels, turning them into new support. The recent high on September 12, 2025, with a close at 0.6641, aligns perfectly with reports of the pair approaching the 10-month high mentioned in the news. For short-term traders, the area around 0.6550 has acted as a solid support level during this recent rally, with several candles testing and bouncing off it. Looking ahead, the immediate resistance target, based on news reports, is the 10-month high around 0.6670, followed by the channel's upper boundary at 0.6680 and the 11-month high of 0.6687. A decisive break above these levels could open the path towards the psychological barrier of 0.6700, which would be a very bullish signal for the pair. Conversely, if this rally loses steam, initial support lies at the 9-day exponential moving average, cited in news at 0.6598, which is just below current levels. Further support would be at the channel's lower boundary around 0.6560 and then the 50-day EMA at 0.6524. Now, switching to the 1-hour chart, let's look at the more granular price action that built this recent strength, specifically focusing on the last week of August 2025. You can observe the consolidation and accumulation phases that preceded the larger daily movements. The price was largely range-bound between 0.648 and 0.653 during this period, with buyers and sellers testing these boundaries. High transaction volumes during these periods of indecision can often signal that a significant move is brewing, which indeed played out. This tighter timeframe highlights minor pullbacks and recovery attempts, showing how small victories built up to the more substantial daily gains. Traders could have found opportunities to scale into long positions as the price repeatedly held above key hourly support levels during this consolidation. To get an even closer look at the immediate price action and the recent surge reported in the news, let's move to the 15-minute chart, covering September 9th to 12th, 2025. Here, we can clearly see the aggressive buying that led to the reported 10-month high. On September 11th, multiple consecutive green candles with increasing volume pushed the price from around 0.660 to well above 0.665. This kind of rapid upward movement on smaller timeframes confirms strong short-term bullish sentiment. Traders looking for entry points could have identified dips to the previous 15-minute resistance levels, now acting as support, to join the upward trend. Notice the slight retracement on September 12th, This is a natural cooling-off period after such a strong rally, potentially presenting another opportunity for entries or profit-taking. The resilience of the price around the 0.662 to 0.664 zone after the initial surge is a good indicator of underlying strength. For intraday trading, monitoring these smaller timeframe movements is crucial for capitalizing on volatility and managing risk around the daily key levels. To recap, AUDUSD is currently navigating a pivotal moment. Key price levels to watch are the immediate resistance zone around the 10-month high of 0.6670 to 0.6687 and the psychological 0.6700 mark. On the downside, crucial support levels are at 0.6598, 0.6560, and the long-term historical low around 0.62. An unbiased prediction for the short term is a moderate to high likelihood of AUDUSD attempting to break above the 0.6670 to 0.6687 resistance zone, with a 60% probability. This likelihood is reinforced by the persistent central bank divergence, strong Australian economic data, and continued expectations for Fed rate cuts. A successful breakout could target 0.6700, presenting a bullish trading opportunity. However, a failure to breach this resistance, perhaps due to a stronger-than-expected US dollar recovery or shifting Fed sentiment, could lead to a short-term reversal, testing the 0.6598 support with a 40% probability. Long-term, the outlook is more mixed, while current factors favor AUD. Some analysts predict AUDUSD could trend towards record lows in 2025 if the Fed's rate-cutting cycle slows more significantly after their initial 2024 adjustments. Therefore, traders should closely monitor upcoming RBA and Fed policy statements, U.S. jobs and inflation reports, and particularly China's economic indicators, as Australia's commodity currency status makes it highly sensitive to Chinese demand. Geopolitical events, especially those impacting global trade or involving a potential shift in U.S. presidency with Donald Trump, could also inject significant volatility, making adaptable trading strategies paramount. Always remember to incorporate robust risk management into your trading plan, regardless of the market outlook.